Hello and welcome to Portfolio Matters. In today's short episode, we will be discussing the current European gas crunch and whether we expect it to continue. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, tell us all about what's going on with natural gas.
Thank you, Richard. Okay, so UK natural gas prices are going absolutely through the roof. So this is the December 21 contract on the International Commodities Exchange. And you can see that back in April, the price was about 40 pence per therm, and it's now £1.62. Now, what's going on? Well, there are several things going on. First of all, we have very low gas storage numbers across Europe, but also in the last week, we have seen very low renewable energy in the form of wind power coming onto the grid. And so the backup is coal and gas plants, and coal plants have been coming back online and natural gas has been bid up for power. And this is the electricity price in the UK. And you can see it's spiked through the roof. And this is a price chart going back to 2010, which puts things in perspective. And the UK gas network is connected by 3 interconnectors to continental Europe and Ireland. So we have one to Ireland, one to Norway, and one to continental Europe. So the UK gas price will be very strongly linked with the European gas price, which is also going through the roof. And this is the 1 year ahead Dutch TTF gas future. You see that the price has been rising very strongly, which shows that traders are expecting disruption to continue into next year. So what's going on? Well, we have very low gas storage numbers in Europe. The dark green line is 2021 and the dashed line is the 5-year average. And you'll see that storage is very low for this time of year. So traders are worried about what's going to happen this winter when gas demand properly comes back from its summer lows. And this is the storage in Europe. So the black line is, I believe, storage capacity, and the blue line is how much gas is in the system. And you'll see that last year, and this week last year, there was 1,044 terawatt hours worth of gas stored in Europe. And this year, it's only 781 terawatt hours. Now, using those numbers, we can work out the metrics on how much we are short gas. And the bottom line is that the current shortfall is equivalent to around 5% of UK plus EU gas consumption. That is actually quite a substantial number. And the big hope is that the Nord Stream 2 pipeline from Russia, which comes online later in the year when we get the legal paperwork done, has a capacity of 55 billion cubic meters per annum. And we are short about 25.6 billion. So that is equivalent to around 50% of the annual capacity of Nord Stream 2, which puts things in perspective. So it is unlikely that Nord Stream 2, even if it were to come online immediately, could alleviate the gas crunch. What's going on? Well, a big part of the problem is Russia has cut its gas supplies to Europe. Currently, all the gas coming from Russia comes via the Yamal pipeline through Ukraine. Now, in August, exports via the pipeline were 20 million cubic meters a day. In July, they were 49 million, but normally they're 81 million. So that is an enormous drop. Now, what's going on? Well, what's going on is Russia is obviously a huge gas producer, but actually it's also a great gas consumer. Something like 55 or 60% goes to domestic use, and its domestic stockpiles are running low. So it is diverting exports to Europe to its own domestic stockpiles in order to build them up for its own winter supplies. And Bloomberg are estimating that in order to rebuild its stockpiles to the desired levels, it would have to divert 100% of its European exports to the domestic market until mid-November. So this is likely to continue. Now, what the other thing that's going on is in 2020, there were 0 liquid natural gas final investment decisions. So there were no new projects coming online. And in the UK, natural gas production fell by 28% so far this year. So the failure of the UK to invest is having immediate effects in gas production. In the US, shale gas has stalled. It's actually back to 2019 levels now, but down from its peaks. And in Norway, so far this year, gas production has disappointed. So the blue dots daily production in 2020, and you can see the red bars, which are 2021, are generally below this, although the forecast is for a pickup in the second half, although you'll see that there's no growth. And so this has surprised the market. In Q3 2020, Wood Mackenzie were essentially forecasting that the LNG market would be in balance and that there would be enough new projects coming online to keep supply and demand in balance. And clearly, that hasn't happened. We now have a global supply shortfall. But given enough rigs, there is plenty of gas still available in US shale. And if they get the rigs back working, you can get a big increase in US gas supplies. I should also say the other thing that's happening is that LNG supplies are being diverted to Asia, where prices are very high, although now European gas prices have caught up with Asia. Medium term, you should see gas prices coming back down towards equilibrium. But in the North Sea, it takes something like 6 or 7 years to find and then develop a gas field. You need to keep on investing, and we have cut investment. In the US, shale can be brought online within a year. Now, the blue line is the current gas price in Europe, and the red line is the gas price in the US. And people are complaining about the gas price in the US, but they ain't seen nothing yet, because you can export US gas to Europe by liquefying it, and you would expect that to happen. So expect tightening supplies in the US and that rising price there, and falling prices in Europe as we get supplies from the US. So these are forecast from the IEA, sorry, and that is natural gas demand going forward. And you can see it's expected to rise, but then so is supply, as long as we keep on investing in it. And currently, what has surprised everyone, including me, is the discipline being shown by shale gas drillers. And they are not yet going back to work and increasing gas supply. But with prices being elevated, you would hope and expect that to change. So in summary, we have a gas crunch going on right now, and it is now too late to avert a supply crunch this winter. So although prices are very elevated right now, there is little prospect of them returning to normal in the near future. But medium term, things should return to balance. It's a question of how long. So we're seeing various extraordinary factors leading to this crunch, but this crunch will continue for quite a long period, is my expectation. Richard, your thoughts?
Thanks, Keith. It's really very interesting. I was taken aback by the Wood Mackenzie projection and how wrong it was of natural gas supply and demand. And it actually illustrates how difficult it is to get these things right, because they do know what they're doing. I wonder, having tasted high prices, you do wonder, obviously new entrants, but you wonder how, if the existing incumbents are particularly keen to increase production, because their profitability is going to be hugely up on the back of these prices. I think that there will be personally, I think there'll be a knock-on impact onto the carbon market in Europe, and I think that the plans for Europe to increase the cost of producing carbon will have to be scaled back hugely, because the price of electricity is unsustainable.
Yeah.
And by adding an additional tax to it, they are going to create huge problems for themselves. And to that end, I'm thinking of selling my carbon futures investment. It's an ETF, but I'm thinking of selling it because I don't see that Europe can maintain the plan that they have for those right now. I think they're going to have to step back. I think the effect on electricity prices is going to be very damaging, potentially very damaging to economies. And I think this underinvestment is actually possibly not over, because there is so much pressure from the ESG movement, if you like to call it, to not spend any money on prospecting for fossil fuels anymore.
Yeah.
And I suppose my final point is that we've invested vastly in natural gas electricity production when when we shouldn't have. And 20 years ago, we should have invested in something else, not natural gas production, but we have. And it is a bit of a mess, isn't it? And it's really interesting to see you break it down like that. What do you think, Keith?
Well, I think you've made a very good point, Richard, in that we in the UK invested a lot in gas-fired power stations when you've seen that our own production is collapsing. It's fallen, like, is it 28% this year alone? Yeah. And that makes us hugely dependent on imports from Russia and LNG and Norway. And the bottom line is we're now competing for supplies in a global market. Yeah. And, price is high, and we are very heavily exposed to tight supplies in the world market. So,
and of course, it totally highlights the dangers of relying too much on renewable energy, whether it's solar or wind.
Yeah.
And you have to be, in your models, you have to take the fairly extreme tails of the distribution of that energy consumption as regular events, so that you don't get caught out like this. I suspect we're not actually doing that.
Yeah. But in the short term, we need more supply to fix this market. Otherwise, there's going to have to be demand destruction, which means the price needs to go high enough that the marginal consumers can't afford it. And that, frankly, is the weak.
And also, and you're quite right, Keith, but the problem with that is that it also means the marginal consumer won't be able to afford electricity, because the two are very intimately linked. And that's where I think you come down to social problems. We're heading into winter. the marginal consumer, poor, less well-off people won't be able to afford to heat their houses, and it is potentially a real problem, I think.
Absolutely. And all that, frankly, is ahead of us, because I don't think that people have really concentrated on this issue yet.
Yeah.
But I think as the winter approaches and gas prices stay elevated, then it will become more of an issue. Because the thing is, there is no way we're going to fix this now, because there's no prospect of extra supply coming on in the very short term.
I think that's right. And it's going to have a significant impact on inflation as well. So, yeah, it's all doom and gloom, really.
Yeah. And on that cheery note, we will leave it. Please can you press like and subscribe to the channel, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.